Hello and welcome to this edition of the Bourdier Monday Report for June 29th. The most anticipated statistic last week was inflation in the United States, namely the PCE and core PCE indices, which are the most closely watched by the Federal Reserve. And as you can see here on the left, these indices rose slightly in June by 0.45% month on month for the PCE and 0.3% for the core PCE, which translates to 4.1 and 3.4% year-on-year respectively. But these figures are in line with, or even slightly below, expectations, which allowed the 10-year yield shown on the right to continue its downward trend by nearly 10 basis points, and that's good news. This trend can be explained on the one hand by the speech of the new head of the Federal Reserve the previous week, but also by the continued sharp decline in oil prices following the memorandum signed between the United States and Iran. In fact, the price of a barrel dropped another 10% last week and has now returned to its pre-conflict levels in Iran. At the same time, sovereign bonds therefore rose by about 1%. All of this could have been good news for stocks, but as you can see here, the American and emerging markets, as well as Japan, which is not shown here, fell sharply, with the exception of Switzerland, which rose by nearly 3%. So for what reasons? The market switched to risk-off mode last week, favoring sectors like healthcare or consumer staples, which carry significant weight in the Swiss index, where tech is almost not represented at all. And it is indeed the technology sector that weighed on the other markets, especially the most exposed indices, such as those in the United States, but now also the Japanese and emerging market indices, in which this sector and its related industries have significant weight. And the reason becomes clear here through the performance of the hyperscalers. The tech giants, Alphabet, Amazon, Meta, and Microsoft, or Oracle first and foremost, are now all underperforming the US technology sector since the beginning of this year. Capital expenditures on artificial intelligence infrastructure by these players will increase to such a level that they are expected to consume more than all the cash flow generated by their operating activities in 2026. This leads to debt issuance and probably some capital raising. And the market simply cannot apply the same valuation multiples to cash-consuming companies as it does to companies that have historically generated strong cash flows. We are convinced that these investments will ultimately be monetized, at least in part, but it is the question of the time horizon required to achieve this that should guide equity markets in the period ahead. This is a risk to be factored into the investment strategy, which also reminds us that there are opportunities to reposition in other sectors that have been neglected for months, such as healthcare or certain segments of consumer goods that benefit from the drop in oil prices. That's all for today. Thank you for your attention. We would like to wish you an absolutely wonderful week, and we look forward to seeing you once again next week.